Maryland. We're just really shaking it up a lot today. And, again, same thing. We continue to dig deeper into a market that just continues to bleed higher and higher. We are going to continue to navigate this as best as we can as we try to make sense of just the never-ending insanity that has become our financial system. But that said, we're going to dive into things in a moment. I want to let everybody get a couple seconds in before we dive directly into this. Good morning to Tall Text. Good morning, Eric in Northport. I did miss you in the chat yesterday, Eric. You are a staple of our chat. So very good to see you this morning. Good morning, John. Good morning, Dillip. Les, B.S. Donnelly, Jacqueline. Thanks for taking the time. Over in our other room, Luciano, good morning. Good to see you. When will gold and silver markets top out? I would stop trying to beg for that to happen. Kramer's here. Dave, Sparky, ABA, Jack. Thanks for taking the time to join us this morning. All right, let's dive into it because, again, there's a lot going on in this environment and things continue to shift and kind of defy expectations, which is kind of what we're looking for, right? More questions, the better, more the opportunities are. But once again, this is a reminder of why you join us in the morning at 9:30. You will be the exit liquidity of this market. And we continue to just focus on what's worth trading, what's breaking out, what's breaking down, where is order flow, what opportunities are going to emerge during the day. We'll go through the top screens, the top stocks, the top strategies as well, and show you where some of the positioning is on the smartest money in the world. As always, we start with momentum, and momentum remains extraordinarily strong. No doubt about this. And we continue to just simply note that as we dig deeper into the state, it says that I'm sharing, but I'm making sure that I have this correct. Everybody see my screen correctly? Yeah, it's there. Okay, good. So continuation in this trend, momentum remaining quite strong. And what are we seeing at this exact moment? Well, that's kind of the point of our conversation this morning. The AI trade remains extremely strong. China remains extremely strong. So the question is, what's driving all of this madness? Liquidity continues to expand globally. We continue to see strength from the People's Bank of China. And there seems to have been some level of comfort from the recent Treasury auction or Treasury buyback that just transpired earlier this week, kind of another showcase to the world that the United States Treasury Department will step in and provide some liquidity support where necessary. The ADP came in weak, but we don't have any insight or any knowledge of all of what is happening with the official jobs number. And the markets don't really seem to care because, once again, it is further proof that this is about liquidity and not about reactions to specific numbers. We will get updates as they come, but for right now, we are burning toward levels that we have never quite seen before. Looking at the future side, 67.71. Keep an eye on the Nikkei, 46,000. And gold pushing that 3,900 level. That gauge that we're focusing on, it's a little softer than where we were. Breadth looks fine, more breakouts than breakdowns. And early leadership is showing up in energy, cyclicals, and a little bit in the financials, which is surprising given the recent downturn that we have seen. Overall, Russell 2000 momentum remaining strong, continued strength. The selling pressure that we are typically worried about has really abated in recent trading sessions, just showcasing that there are about 2-to-1 level of stocks in breakout mode versus breakdown mode. That said, keep an eye on consumer services, cyclicals, defensives, and financials that have been weak in recent weeks. But as we've noted, it looks as though the market is looking to continue its burn higher as a result of that move recently off of key moving averages. We've seen multiple moves this year where the market has basically given us a little bit of a hip check, made us think a little bit about the concerns that may emerge on the macro level. And we basically tested these key levels, this 20-day EMA. We've touched it a few times in recent months, and yet the market just turns right back around. Interestingly enough, that has been where we have hit yellow on our S&P 500 reading, and the market has taken right back off. Those periods were August 1st back around August 21st. We had a little bit of a down blip in September 3rd. And then the most recent move where we went effectively to yellow was back here on the September 25th. So again, continuation of trend, continuation of strength. Liquidity creates strength, and therefore all markets go burr. More proof of all of this. U.S. equity funds saw $63.4 billion of inflows last week. That's the largest since November 2024. So since the election, when this market took off, this was the strongest period of inflows. The focus continues to be, hey, there's rate cut hopes driving risk on flows. That is the narrative, right? That's the narrative of the story. But the reality is there continues to be more supportive accommodation in the global markets, particularly out of China. And again, what the Treasury Department did this week with that $4 billion support in buying back bonds. Now, again, there was $12 billion that was offered, but they effectively provided a little bit of comfort and supply to the system. And these are just the little tiny minor things that we're looking for in terms of the macro perspective. So we're going to keep an eye on the SPY, the Qs, the DIA, and the IVV. And yes, I do still feel quite concerned about what's going on with private credit, what's going on with the regional banks. That hasn't abated. But the reality is that simply because I'm warning about it now, some of these things can take weeks, even months, to lead to the outcomes that I ultimately anticipate. As liquidity expands, given that gold is a proxy of that, spot hit around 38.60 per ounce, driven by shutdown fears and Fed easing bets. That's the narrative, right? A lot of focus on highlight liquidity stress. The reality is global liquidity continues to be strong. We're utilizing liquidity stress through the mechanism of what's happening in the banking reserves, which have just hit about $2.98 trillion. Still a problem. But for right now, it still is risk on for gold. And we are seeing, again, continued moves to the upside, continued trend to the upside, strength in this trend. If you don't want to chase this, obviously, we want to look for spreads down lower. I have consistently advocated for selling put spreads down near the 50-day moving average. We have not tested the 20-day moving average in about 2 months. But that said, I'd rather take a high probability trade and have the capacity to step in and buy these things if there is weakness instead of trying to chase the momentum. So we'll talk a little bit about that and effectively what that means in terms of utilizing spreads and credit spreads and high probability trades later today when I am on in the final hour. Same thing with silver, which is now moving back to that $48 level. Oil prices have been under a lot of pressure this week, despite that intraday rebound and that focus on Russia. OPEC signaling signals on increasing production. We talked about creme brulee yesterday, SLB. It does not look like there is continued momentum in SLB. But again, looking for this to move above these key moving averages, it just simply is not arriving. So I'm going to hang out on that for now. We did not get that continued strength. Keep an eye on Exxon, XOM, 111. Still trying to hold that 50-day moving average. If it cannot hold its 50-day moving average, then obviously looking to the downside. At Exxon announcing 2 days ago that it was laying off 2,000 workers because of declining oil prices. We'll continue to monitor that and the OILU. Stocks are at record highs because why not? And I know it defies expectations. I know that everybody continues to look at valuations. I continue to just simply advocate and argue that we are in the middle of a massive liquidity wave that is expected to continue well through 2026 until we eventually will hit our peak. Where that peak looks like could be 7,100 on the S&P 500. It could be 7,500. But the reality is we sit here and we watch this happen. It is defying expectations. It is defying logic. We are looking at historically overvaluated markets, but you are starting to see people like Bank of America, some of their analysts, some of these other hedge funds and private equity groups are coming out and saying, well, maybe this is the new normal. Well, it's been the new normal for at least 17 years, right? The S&P 500 has moved on the back of loose loose monetary policy by the Federal Reserve, dating all the way back to really 1971, 1993, but 2008, where it accelerated with the introduction of quantitative easing. And since then, especially 2022, 2023, they have found new ways to provide support to the financial system, which increases risk, increases leverage, increases credit, and resultantly leads to higher risk assets and really the price of everything that matters, from housing to electricity to education. In addition to this, right, despite the fact that we have all that noise around the shutdown, whatever that sideshow was of trying to broadcast the shutdown live for 24 hours like it was some sort of Grant-a-Wish telethon that happened yesterday, the reality is that the markets are not necessarily focused on the underlying economy or DC policy. They are being established by momentum and liquidity. And the AI trade continues to dominate. That's why we're continuing to focus on NVIDIA starting next week with our masterclass. At the end of the day, this market is just pure fundamentals and quantitative flows. The SPY, the Qs, JPM, and once again, we continue to note that when it comes to understanding where opportunities persist, USAR adding another 11.6% yesterday. We talked about it briefly yesterday. The question is, which way is this going to move? Obviously, there are a lot of questions about it. The reality is this, right? You're up 10% this morning about talks with the White House. The reality is this is a political premium trade, the kind that can really surge fast, but it will fade just as quickly if the follow through is not there. The playbook is pretty simple for a stock like this. If the flow builds, momentum traders will chase it. If it does not, hedge sellers will slam it down into the ground. And this is the kind of name that exaggerates the tape when liquidity and questions about where money should be flowing start to build. Finally, I do just want to point out that when it comes to the ongoing global flows, the Bank of Japan is trying to calm their own markets. And this seems to be where the real problems have been persisting, and people have been largely ignoring, largely because it's not close to us. So if we look at, what has happened here, this downturn that we have seen, we had a note in the chat the other day that there seemed to be some level of coordination and questions around what the Bank of Japan was going to be doing. And it seems that this downturn that has occurred, particularly in the shadow banks and the private equity side and even private credit, is probably linked to something happening over there. If we go to Tokyo real quick, Iyuda, the governor of the Bank of Japan, saying that global uncertainty, especially U.S. labor conditions and tariffs, complicate their path. So there is no rush for them to hike interest rates once again. Markets think December is the next possible move for Japan, and that tone pushed the yen lower. As we take a quick look right here. Why does this matter? It's an FX story, but dollar-yen pairs are back in play, particularly the focus on if the Fed cuts while Japan stalls, the yen will get weaker, or at least that's the expectation, and that will spill back into equities. You have to remember that the last time that we had a very significant event in Japan, it was last August, and it's just a reminder that we have no connection, no real connection or independence when it comes to the Federal Reserve and the other central banks around the globe. As I noted, the Bank for International Settlements put out a report in April of this year. And in that report, it effectively noted that the United States is completely linked to every other central bank in the world. So whatever the U.S. Fed does, it does have to think about what's going on in Brussels, what's happening in Japan, what's happening in Frankfurt, what's happening in London. Effectively arguing in this piece, it was a devastating report that, think of it this way. Think of the fact that you own your own house, and for 30 years, you change your thermostat, and that impacts your house. But then all of a sudden, down the road, someone else moves in and they change your thermostat and it starts throwing off your temperature in your house. That's the interconnection of all of these central banks. And it's largely because they are all heavily interconnected through the post 2008 financial system, which is related through these hedge funds, shadow banks, intermediaries that really did not have that level of impact and control that they did before 2008. Basically, after 2008, traditional banks have abdicated their role in the financial system, and these shadow banks and these private equity firms and these hedge funds, broker dealers, those individuals are effectively now in charge. And when some other nation sneezes, we certainly are feeling it. So it definitely feels like the issues here with the KRE are linked to our banking system, and there certainly is that argument to be had, especially around the regionals. What's happening with things like KKR, which has been beaten up in recent days. The point is there is something else brewing internationally that we're not paying attention to. And every time that I forget about Japan, that's usually when Japan creates a problem. Finally, it is 9 o'clock. I know you've been waiting patiently, and I know that Charlie has something to say about it. All right, we got the runner today. And you're going to see USAR again pop up just in our chat today. But we start with the pretty simple one, and that is, again, within the realm of the momentum trade. That is the ongoing AI play. Everything in AI is back in play. Again, we are coming on AMD, and this is exactly the type of short-term technical move that we're trying to take advantage of. There's a lot of different ways to trade AMD in this environment. But if momentum is improving, it's easy to chase. You could potentially buy something in the money for next week. You could potentially, buy a simple spread at the 170 and sell the 175, or even buy the 165 down around that 20-day moving average and just sell the 170. I mean, it really kind of comes down to the type of level of let's get rid of the ad. All right. AMD. Let's get rid of the ad. Everybody's selling stuff. I got to get a premium. There better be a premium plan. If there's a premium plan for this that has no ads, I will buy it and I will pay all the dollars and we won't have to look at it anymore. You can buy the 170, 167.70 for next Friday, and you could sell the 170. And what this is going to produce is actually a pretty interesting trade for $1.33. What this produces is a trade where, if you look at this, you're buying the 167, you're selling the 170. The 167 is back here, right between the 120, right between the 20-day moving average and where the price is right now. What that creates is a $1.33 trade aiming for $1.70 next week. What's your break even? Your break even is 168.75. So you've got $2 to play with right now, just for the next couple of days, if you're looking to chase the momentum. And what's your probability of profit? 54%. So an 88% max return, 55% target. Now, if you change that, now remember, you have all of the room up to 174, because when you're trading a spread, the one that you are selling gives you the break even up to the top of that call range. So 170 plus 470 equals $174.74. You can capture the gains up to that level. But if you try to even go a little bit deeper in the money, this is another way to trade this that has a higher probability of profit. Almost the exact same price. But as you can see, in this, you're putting up $155 to make $95. And what does this do? It gives you protection back to this 20-day moving average, assuming continued momentum. And what you're looking at right here is 166.67 becomes your break-even price by the end of expiration next Friday. But if the stock continues to move higher, right, your upside is 61%, and your probability of success is 62%. And the more you go deeper into the money, the higher the probability of profit. But as you can see, you add 167.50 plus $6, that puts your break even at 17, or your top of the line at 173.30, which is where you max out on that trade. If you went even deeper, it changes as well. Again, it all comes down to your risk tolerance. But I'm just showing you that you don't have to just go out of the money. You could still have a relatively sizable return. That's not what trading is. It's really about understanding and focusing on the key details of what your positioning is before you enter the trade to begin with. So the downside here, back. We'll talk about Prim in a moment. Let me just continue to pour through what else we got. Hope any questions around that. All right. Thanks, Tall Tex. I appreciate that. All right. RDW had a run. BBBY had a run. RXRX. Okay. So there's no doubt about the fact that we love this stock. It's going to be very, very important in our NVIDIA conversations as we start next week. This is one of the proxies that we will be talking about. And you'll find, interestingly enough, that you believe that there was a pure correlation between the biotech sector and this stock. Reality is this stock does a pretty solid job at tracking the performance and the moves of NVIDIA. This is a kind of backdoor AI play. And it is a stock that, you don't need $180 to trade NVIDIA. You can trade RXRX using the same types of mechanisms that we'll be focusing on in our masterclass on Tuesday. And then through the 6 weeks of the program that follow and the additional 6 weeks of trading. This is a great momentum stock. It does a wonderful job at doing nothing for a couple of weeks. And then when the signals come, breaks out. So RXRX, our signal is back here at around that 491 level. I know that Mr. Idun has been in the chat beating the drum on calls. A lot of focus on those $5 calls from about a week and a half ago. But RXRX is one of those names that if you're going to trade it, keep a tight stop. Looking for returns back up to around that $6 level. Maybe a revisit of that 602 level. There is certainly some room here. It is a great momentum stock, and it is one that we will continue to dig deeper into as we move along through our master course. All right, BMI, Badger Meter. Now, this is a stock that I want you to remember is one of the most infamous insider trading stories ever. What happened? Well, it turns out that Mark Wayne Mullen, senator from one of those states. He's a senator. He bought a ton of this stock, and he bought it while he was on the environmental committee that oversaw the changing in water meter standards in the country. Yeah. This is why you follow not just insider buying at the CEO and CFO level, you follow it at the congressional level. And I'm not talking about Nancy Pelosi. I'm talking about the people who sit on committees and buy their own stocks. BMI has been waiting weeks since that huge crash that happened from that 250 level. Look, we're waking up a little bit. We're looking for a little bit of a squeeze. This is not a huge short float stock, down in around 7.5%. But a move back to that 50-day moving average, definitely in the cards. So what we're looking to do here, if we can find a trade around it, is just play it safe. Maybe just buy the stock and set the stop back here right at that 178, 179 level. It's not the sexiest thing in the world, but it's really just about following and tracking and understanding momentum. Unfortunately, The spreads are extraordinarily wide on this stock. We'll dig a little bit deeper into it, but I would also remind you, if you can trade spreads around some of these things, it's possible, but you have to buy your put first at the price that you want, and then you add the second put that you are selling after that. So when you're selling a spread and you have a very wide bid ask, you want to try to get your price on your put that you would be purchasing first, that leg, because that will provide support for whatever you are going to be selling, and that becomes an anchoring strategy. I'll walk you through that a little bit today as well. We'll be talking about spreads, pretty much the bulk of our 3 o'clock session. But in an environment where you have, $3, $4, you have to be very strategic about it, particularly if it's something that you are willing to buy. On the downside, PVA, what do you do? That can't be right. PVH. Oh, yeah. Consumer cyclical. Clothes that I'm not wearing. I think I've worn the same tracksuit jacket in different colors for like a week in a row. I'm loving this. All right. Weakness continuing. I think you just continue to try to ride this type of cyclical move back down to a retest here on that 50. We'll see what the strength holds. It's really built around the RSI. This has been weakening. This is not a company that looks very healthy. You got an $8 billion enterprise value on a $4 million market cap, debt to equity. It's fine. It's a cheap company, but once again, the time to buy this stock is typically when the insiders do, and the insiders have strayed away from this. Last time, I think we saw purchases back around that $65 level. We're seeing weakness. This is all consumer driven, and the longer this ongoing situation continues with the United States shutdown, there may likely be more focus on consumer blindness in terms of what that economic data looks like. PEGA, same thing. Pegasystems, software application stuff. These are the types of things that I continue to be wary of in this environment. 49 on the PE ratio, basically looking for a move 55 down to around 57.50 down to 55. Tight trade, but nonetheless keeps a very good cushion for you. That 8 is still holding above that 20. Right now, I just want to kind of look for these types of retests before trying to go long on some of this stuff if momentum returns back to the technology space. SLVM, Sylvamo. Again, this goes back to just the general paper products and the kind of underlying economy trades that we've discussed. It's a tough one. Again, it's just kind of hovering around these key moving averages. I don't want to short it at this point, to be honest with you. One, it's a huge move down that we've witnessed. This might actually become a buyout target at some point, just based on the fact that it's trading at 9 times earnings and you're down at an EV to EBITDA of around 5.3. So somebody wants to get in the paper products industry on the private equity side? Possibly. So I'm actually going to wait this out, see what happens with the 8-day and the 20. And this might actually be a reversal play rather than something that I want to short. But I just want to remind you of the weakness right now as we look at this watch list. Overall, from a runner perspective, one of the things just to note on SLVM, stop at 43.38 if you were going to trade it. And looking for, target 90, it's possible. It's possible. It's just one of those things. All right. SCNA, momentum. Seneca Foods, same thing. Just pure momentum. 12 months of this. The 8 just moved over the 20. Strength on the food side. So buying the stock. Stop at 105.51. Looking for a move back to 115 to new highs. On the other side, breaking out technology, basic materials, utilities, and industrials, rotating with healthcare, RX leading. A lot of biotech, AI, and crypto momentum. That is typically that kind of topish momentum focus that we have. If we buy the runner options, are we becoming exit liquidity as he talks about it? I don't want to become someone's next liquidity. No, David. Nope. I am not a pump and dumper. I assure you on that. Look into the Brave browser for less ads. Done. That's the first lesson that we learned today. Didn't realize. You getting a spotty signal from me? Okay. Where do I find what info less? Boris saying time to properly kick off K Street Confidential. I completely agree with you. I've wanted to do that. Calvin Klein going out of fashion, I guess. Yes. Okay. Yeah. So Unusual Whales does it. Quiver Quantitative does it. Quiver Quantitative has a really good site on the matter as well. I am realizing that I am getting a little choppy, so let me move. Let me move a little bit and get on the horse a little bit. All right, we got 4 minutes left. A little bit of an echo. We'll be sitting at the same table that I did my homework at when I was 17. Awesome. All right. I have a Quiver Quantitative subscription. I just don't use it very much. All right, on top of this, yeah, Capital Trades, Unusual Whales, Quiver Quantitative does a good job at it, and it's actually not that hard to dig all that data up. Did I ever look at TNA? TNA is the bullish small cap for the Russell 2000. Do I ever look at it? Constantly. It is our signal on the Russell. The other side of this, though, is TZA. And as you will see, when it comes to our momentum signal on the Russell 2000, typically we see the Russell move to the negative side. And again, TZA, when it is breaking out, that means the Russell is breaking down. That means momentum is under pressure for the Russell. We typically will see the Russell start to move away to the upside on TZA before we see an S&P 500 drawdown. So this is a reminder that, again, when it comes to broader market support, when the TZA is breaking out and it is breaking these key moving averages that I talk about all the time with the FNGD, it's the exact same thing. It's just this is the small cap side of the world, and this is where this is excess liquidity draining. This was the crash that was associated with trade. You'll see this big move here. That obviously was the Japan crisis. This was a short-term crisis with China that nobody really talks about. But basically, they were facing debt deflation, and the Bank of Japan, the Bank of England, Bank of Japan, U.S. Federal Reserve, and the ECB. Yep. Okay. Cool. All right. All right. You're still at a dime. All right. Finally, I do want to just point out when it comes to today, it is Friday. So when it comes to emphasis on volume weighted average price, I want you to remember that everything in options is in play today, right? It's usually around the third Friday, but once again, we are looking for moves down into the third, fourth standard deviation. And from there, what you're looking for, particularly, and I'm talking anything that has significant volume. The key focus is, do we get down here? Do we get an overreaction at any point? And if you do, you buy whatever is at the money and you look for a breakout to the upside. That's it, right? That's it. So we'll continue to be focusing on this. We'll talk a lot about this next week with our masterclass. Again, there still are a couple of spots available left in the NVIDIA 4D masterclass. We will be kicking that out on Tuesday in the afternoon. It is now 9:20. I need to hand this off to Don Kaufman. We will be very busy today. It is Friday, and that is the type of day that we like to trade, looking to scalp and take advantage of what the market is giving us. I hope you guys have a great day. Thanks, Les, Byron. Hope everybody else has a good day. Thank you so much, Dave, Jim, and everyone else. We will catch up with you later today at 3 o'clock. And if I don't see you, I will be back on Monday, 8:45 for Market Masters. Have a great day.